Good afternoon, ladies and gentlemen, and welcome to our webinar today on carbon market and carbon pricing instruments, organized by the Malaysian Sustainable Finance Initiative. My name is Navina, and I represent Capital Markets Malaysia. Today's program is being brought to you by our partners, the ASEAN Low Carbon Energy Program, which is managed by EY. And this session is 90 minutes. It's good to see so many familiar names coming up on the screen. I'm just going to take a few minutes to go through some housekeeping and also to go through the agenda for today. We have three presentations followed by a panel session. Please feel free to ask questions at any time by clicking on the Q&A box and putting your question in. We have 300 participants signed up today, so we won't be able to take live questions. But if you put your questions in the Q&A box, the speakers can then address it during the panel session or after their presentations. So we'll start first with a presentation by Arina. I think most of you will know who Arina is. She's partner for climate change and sustainability services for EY Malaysia. Following that, we have a presentation by Kasia Lewis, who is partner at the EY Law Office in Poland. Kasia has extensive experience in advising on international regulatory regimes related to energy, climate change, and the environment, as well as sustainability law. She's had experience on the EU Green Deal, assisting organizations in understanding its impact, managing the risks, and implementing compliance strategies. We also have with us Andrew Howard from Verra. Andrew is Senior Director for Climate Policy and Strategy, and he leads the Verra strategic engagement to develop opportunities for carbon-related standards and build greater ambition in climate action. So we'll start with these presentations, and then we go into the panel session where these speakers are also on the panel, but we also have with us Sue Phillips and Mark Kenber. Sue currently works as an independent gender advisor and has been working with the voluntary carbon market to deepen its focus on the benefits of embedding gender equality and women's empowerment into high integrity initiatives. So Sue will have a very brief presentation and then join the panel session. We're also very fortunate to have Mark Kenber join us. He's Executive Director of the Voluntary Carbon Market Integrity Initiative. Mark is also instrumental in this area as he founded the CDM Gold Standard and Verified Carbon Standard. So a really great lineup. I'm not going to take any more time. I'd like to just hand over now to Arina. So Arina, over to you.
Thank you, Navina. So maybe we quickly get into the conversation. So I think we're going to kickstart with first understanding the growth of the global carbon market and what we're seeing in ASEAN. Now, when we talk about tackling climate change, it is quite fairly complicated and fairly new for quite most of what we've seen in the ASEAN region. What we are seeing is to realize the ambition to reach the 2015 Paris Agreement's target to limit the impact of climate change to 2 degrees Celsius above pre-industrial level. So the global emissions would have to cut approximately 55 additional gigatons of CO2 by 2050 on top of today's commitment. So we've seen quite a number of corporates have already put out their commitment to net zero or carbon neutral. Now, what we are seeing is the carbon markets and the ability to offset is going to be quite a vital, if not critical, part of the solution. So through these measures, businesses will then be able to put a price on the emissions and to make a decision or choice on how best to tackle. Because to some extent, some sectors would take some time to decarbonize as compared to the others. So it's important to understand when it comes to financing, what are the source of financing, and when it comes to net zero or even negative, we are going to hear a lot going to net zero and eventually carbon negative. What would be the emission solutions? So private capital really can play a crucial role to ensure the flow of finance to grow this role of nature-based solution in capturing and storing carbon as well. Now, what we have outlined here is what we see from UNEP. Is also there will be a US dollar of 8.1 trillion of investments by 2050 that would be necessary to address the interlinked issues of climate, biodiversity, and land degradation. Now, this is 4 times the current level of investment. So we are fairly behind, but it also means there's a lot of opportunity to scale these further. And there is a US dollar 4.1 trillion of gap in financing nature preservation and restoration, which cannot be filled by public financing alone. So next, what we see is when we talk about carbon pricing instruments, how it plays an active role in decarbonization. This is a chart that we've put out from EY just to outline when it comes to having the baseline carbon footprint is the first part where most organizations will start to calculate their scope 1, scope 2, and scope 3. If you see green towards the blue, those are the emissions. Domestically, we have seen domestic, regional, and international emissions trading schemes, all and including carbon tax, will play a critical role in 3 out of 4 decarbonization commitments. So when we talk about decarbonization commitments, there are different ways to decarbonize, and each one will show different strength of decarbonization. So when we talk about science-based targets, we are looking at here that it does have a real, is Paris aligned greenhouse gas and reduction target. So for science-based target, in a very simplified manner is you can't just go for offsets, you have to demonstrate real reduction against science-based. And when it comes to carbon neutral, it is emissions that can be also reduced based on offsets and removals. Whereas carbon negative is when science-based is set and the emissions have been offset much more as compared to the emissions of the company. So net zero is when science-based targets is achieved and residual emissions equal to removals. So in short, if you go for carbon neutral, you can do offsets, but for a stronger commitment is to show a real reduction against science-based targets, which means company need to reduce to a level that is possibly reduced before you can think of even offset. And there is framework under or approaches under the science-based target to navigate what you can offset. So if we go on to the next slide, when it comes to the use of carbon credit, it's important that this will be a strategic play. And when we look at the role and contribution of carbon credits, now we've outlined here from our EY Net Zero Center report, where if there is a need to, where we see there's a failure to actually reduce emissions intensity to be at a level or below, there will be lower stakeholder pressures, and there will be time needed to prepare and identify what are the other options to reduce emissions and secure the future offsets. Now, in short, what we are seeing is quite a number of organizations with net zero or carbon neutral are starting to position their emissions reduction and their buying future, and not just looking at the annual offsets mechanism. So using carbon credit can buy time, and it will also allow cost-effective emissions reduction to harness the asset turnover and build out new product offerings and business models. So we are also seeing when it comes to prepare, scope out the response and reset the strategy, quite a number are going through that maturity because we are seeing that there are emerging trends of businesses that are moving towards, once they've have enhanced the way they're offsetting their organization emissions, they're also looking at how do they take on to the next level of strategy to position and build competitive advantage. Now, one thing to note is failing to reduce emissions intensity at a level that will be on par, or if the failure is performing lower than the key peers, it will drag the organization's competitiveness because this will actually result in organizations eventually have to pay higher when you need to purchase or retire offset credits. And all these are going to be monetary cost to company moving forward, especially when there's a taxonomy that will come into place. So when it comes to what we are seeing in this chart as well, based on the emissions intensity, that will also be one of the metrics to decide how the positioning of carbon credit and what is the decarbonization strategy required. Now, if we see at the bottom right, lower emissions intensity will create room to spend on credits with co-benefits that will align with brand value or offer other sort of synergies. So ongoing action is required to maintain what's the desired relative position and decarbonization advantage. Because not all organizations will hit a net zero next year, but it is over a gradual of time, there will be emissions reduction. And the emissions intensity is the one that has to be monitored over time until the emissions hit a net zero or carbon neutral. So if we go on to the next part, is just a quick introduction to carbon pricing mechanisms. So a carbon price is essentially a cost applied to carbon pollution that will encourage polluters to reduce the amount of greenhouse gas that they emit into the atmosphere. So there are different types of carbon pricing mechanisms, different types of CPM. Under the explicit carbon pricing, we have the voluntary carbon market, the VCM, whereby it functions outside of compliance market. It is project-based emissions reduction credits, whereas under the compliance market, it's created and regulated by mandatory national, regional, or international carbon reduction regimes. So we see the emissions trading scheme, ETS, as well as carbon tax, whereby explicit tax rate are applied on emissions or carbon content of fossil fuel. Now, when we talk about implicit carbon pricing, it is an internal tool that is gaining a lot of traction for a few companies in Malaysia that we've seen, whereby these internal tools are used by entities, corporates, government, financial institutions to guide decision-making. So by having internal carbon pricing, what's the use case? Is to apply it to the emissions so that there's an internal carbon fee to reduce emission internally first before any taxonomy kicks in. And there is a theoretical price on carbon to evaluate the investment strategies, or we call it the shadow price. So for example, if an organization is going to build a power plant, whether it's going to be a gas plant or renewable energy, or a coal plant, which there will no longer be coal plants. But if there is a need to build, there is a shadow price to see that if a taxonomy is put in place in future for coal, there is going to be additional cost when it comes to looking at investment strategies. So those are the shadow price or internal carbon price that will be applied when it comes to implicit carbon pricing. So a lot of organizations are also monitoring globally how the carbon pricing instruments are available worldwide. So there are 67, and we have seen under the EU ETS, Kasia will cover that in a short while. We've also seen Mexico having the carbon tax since 2014, very much looking at compliance sectors for producers and importers of fossil fuel, except for natural gas. So we are seeing in 2021, China has also implemented the ETS, emission trading scheme, whereby it is covering the power sector, emitting over 26,000 tons CO2 annually. So the price is renminbi $59 per ton CO2. And what we're seeing that it is also going to be increased over time to also consider the step up of the carbon price. So for carbon tax in Singapore, since 2019, closer to our shore, it was implemented in 2019, and it is going by facility level. So the tax is on what are the emissions by facility level. Now, what's interesting for Singapore carbon tax is there is an implicit, or at least the government has announced, from a $5 per ton CO2, it is going to be increased for future price. So 2024 to 2025, it will be $25 per ton CO2, and eventually move to 45. And by 2030, the projection is it is going to be $50 to $80 ton CO2. So now that will allow companies or financial to then decide and model what their emissions reduction would need to be in order to ensure that they are not caught by higher prices of carbon tax. So when it comes to the overview of carbon market in ASEAN, we've seen Indonesia have a voluntary pilot compliance market plan for 2024. The government and regulation on environmental economic instruments passed in 2017 mandates the implementation of trading system within 7 years. And there is a MRV guidelines that have been also released. So for Philippines, it's a compliance market under consideration. The Low Carbon Economic Act, conditionally approved in 2020, contains the provision for a domestic emission trading scheme, although no timeline has been set. So for Thailand, they are considering a voluntary compliance market under consideration, and they have the Thailand voluntary ETS launch in 2050. So the National Climate Change Master Plan 2015 to 2050 refers to carbon market as potential tool to achieve their emissions reduction in line with the Paris Agreement. So for Vietnam, it is a compliance market by 2022 planned, and the Law of Environmental Protection adopted in 2020 establishes a mandate to design a domestic ETS and crediting mechanism, allowing for the inclusion of international efforts. So for Malaysia, Bursa will be launching the voluntary carbon market exchange by end of this year, and they offer to standardize carbon credit products for trading via rule-based VCM exchange, and there will be a supply of carbon credits to be sold by way of auction to interested buyers. We'll hear more from Vera in a short while. So how do we then define carbon credits and offsets? So there are a range of terms used to discuss the use of offsets. Carbon credits can be defined as certified and transferable instrument representing 1 ton of CO2 or equivalent greenhouse gases that has been avoided or removed. Now, avoided here means the gases did not enter the atmosphere, while removed means the gases were removed from atmosphere and safely stored. Credits are created by offset projects and can be retired to offset the equivalent volume of residual emissions by the holder of the credit. So when we talk about the 3 steps, the first is really having the offset project identified. A project to be identified would result in the avoidance of greenhouse gases from their removed from the atmosphere. So common carbon offset projects are really renewable energy, forestry, energy efficiency, or waste management, so on and so forth. All these will create the carbon credit, a certified and transferable instrument representing 1 CO2, as I mentioned, will then be used for step number 3, offsetting. So the process of retiring carbon credits to offset the equivalent volume of emissions by the holder. So if we go on to the next part is, how does the carbon market work? In the compliance market, we'll see that, for example, under the one site whereby the emissions are less than the threshold, the site will actually sell the excess emissions quota within the regulated carbon market, and this will be purchased by the other side with emissions exceeding the threshold. Now, this is aimed for the most energy-intensive emitters typically. Under the voluntary carbon market, organizations with high CO2 emissions will then consider investing in offset projects, eco projects, and CO2 avoidance projects, and that will be issuing carbon credits. So there will be a transferable instrument representing 1 ton of CO2 that were avoided or removed, and this can then come back to an offsetting mechanism. So that also distinguishes what a voluntary carbon market may look like moving forward. So when it comes to the type of carbon credits in the market, we see 4 main types. Under the nature-based solutions, we have the avoidance. So it talks about avoided nature losses. So avoided deforestation and forest degradation covers the reducing emissions from deforestation and degradation. So the red is one of the key ones. And for avoided impact to the conversion of mangroves, peatlands, or seagrass. For removal under nature-based, it is covering the nature-based sequestration. So there will be the reforestation, restoration, regenerative agriculture, improved forest management, or enhanced soil sequestration. When it comes to the technology-based, we also see emissions avoidance or reduction that covers renewable energy, energy efficiency, and fuel switching, or chemical processes, industrial manufacturing and waste disposal, or transport. So when it comes to technology-based removal, it does cover the likes of bioenergy with carbon capture and storage, direct air carbon capture and storage, carbon neutral or negative building materials, or mineralization. So these are some of the examples of the 4 main types of carbon credits we see in the market. Now, supply is likely to shift very much towards the nature-based solutions. So based on the source that we've seen that has been reported by Shell, an outlook on the voluntary carbon market, there is an increasing demand for high-quality offsets that will drive supply of nature-based offsets, while engineered avoidance level of as renewables additionally decreases. So nature-based solutions, we'll see that buyers are interested in compelling stories, for example, value chain proximity and support of sustainable development goals, and high project credibility, driving project development investments towards nature-based solutions and especially removals. Whereas when it comes to engineered solutions, the engineered avoidance supply keeps growing, but levels off as buyer prefer nature-based solutions. Engineered removals will grow, but only start to play a role by 2030. Now, these are scenarios that have been projected. So for those who are interested in this, can deep dive further when it comes to projection. But this comes after organizations have started their baseline, have also looked at the carbon credit pricing and heading towards projecting the market moving forward. So for Malaysia, just to give a context, Malaysia is ranked 7th in the world in share of low-cost nature-based solutions. Now, what we've seen is Malaysia has more than 18 million hectares of forest cover, which could be managed to ensure permanent carbon sequestration. Now, the country has a carbon potential of up to 40 million tons CO2 annually through nature-based solutions projects, which is equivalent to 3% of world's nature-based solution potential. So forest-based sequestration could account for up to 3/4 of Malaysia's crediting potential, which the remaining potential could be unlocked by peatland-based sequestration. So here are some of the statistics we put here. Under the avoided deforestation, peatland restoration, nature forest management, reforestation which cover crops at no-till as well. So with that, we've done the earlier introductory level. Now, if I can move on to the next part, I will invite my distinguished leader, Kazia from EY, to actually talk about the carbon pricing. So over to you, Kazia.
Thank you very much. We can move to the next slide that will let us. Yes. Apologies. I thought the first slide was on the Center for Climate Policy, but so let's keep this slide. This is the deep dive into the role of financial institutions and carbon markets. So I'll expand on what Arina has been saying. She was introducing us to how carbon pricing can be structured, and especially what's Malaysian outlook when it comes to it. But in the session, in my part, we'll try to go a little bit more deeper through the positioning of financial institutions. But before we do it, I just wanted to very warmly thank you for the invitation. It's absolutely lovely to be here, and I'm happy to represent EY Law and also our Center for Climate Policy, where we work predominantly with sovereigns, helping them structure and think through climate policies, then help them implement it, and also help to think through considerations like what should be the role of financial institutions in this space. So when we think about financial institutions and carbon pricing, I think there are two main prongs to this discussion. One is, what is the actual impact of carbon pricing on financial institutions? Is it advantageous? Is it maybe adverse? And if so, what can be the steps to mitigate any adverse impacts of introducing carbon pricing? But then the other consideration is on the actual role of financial institutions in carbon markets. And here, basically, we're showing the basic scheme or the basic flow of transactions when it comes to investing in carbon credits, and this is applicable to both voluntary markets and compliance markets. And against this flow, we are overlaying financial institutions, what their role is, where they step in. And basically, the role of financial institutions can be as a market maker. I think this is probably the most exciting, prospect when we think about the build out of this entirely new marketplace. Then, as obviously a financing agent, as a deal originator, and also as a trader. So when it comes to financing or investing, we can think both about voluntary carbon markets and compliance carbon markets. So when it comes to voluntary carbon markets, and Arina has made that distinction, we can think about financial institutions as investors in the space, as a provider of capital, since a lot of these voluntary carbon credits generating projects are dispersed. They are oftentimes being initiated by local communities or by small local entities. For instance, when we work on these projects, we oftentimes work with pretty much startups, like a local community that has learned about this opportunity, and they are, banding together. They don't have any legal presence yet. So we have to help them think through all of these considerations, but they definitely need institutional and financial support. So there is a big role for financial institutions globally to enter into this space. Maybe just to give you a little bit of flavor, Arina has started discussing it, but this new marketplace has a lot of potential. Pretty much all of the analysts are predicting some really astronomical numbers when it comes to the valuation of this market. Some forecasts even proclaim something like 180 $200 billion per year. Right now we're at $1 billion, so there is obviously a long way to go. But this is the potential that is being attributed to this market, and the rationale behind it is that when both corporates and sovereigns are making those declarations about climate neutrality, then obviously what it means is that every ton of residual emissions that cannot be reduced will have to be offset. So the magnitude of this new marketplace should be on par with the magnitude of the entire economy when it comes to residual emissions. So a big investment opportunity there, and so this is on the voluntary carbon market front. Then when it comes to compliance, obviously companies that are subject to these compliance obligations, they have to invest in decarbonization, not so much to generate credits out of it, but to mitigate their either tax or other regulatory obligations. So either they have to pay carbon tax or they have to purchase the allowances under cap and trade. So as Arina said, when they are thinking about new investments, they have to take into account this social cost of carbon, but also the actual operating cost when it comes to purchasing the allowances or paying the tax. So sometimes there might be a need for bridge financing if they are not convinced that just offsetting or not being liable to pay their cost of carbon in itself justifies a decarbonization investment, then they might be reaching out to financial institutions for an extra bridging financing. And then when it comes to trading, like this is where traditionally looking at compliance market, for instance, in the EU, or traditionally the role of financial institutions has been mostly focused. They are active both on the OTC side of things, but also obviously increasingly trading through the exchanges. So I think that's pretty obvious. But then when it comes to market making, financial institutions have a role in providing for contract standardization, thinking through how to develop derivatives when it comes to carbon credits. This is already the reality. This is already happening in the EU. We do have derivatives market for carbon credits, but when it comes to, for instance, voluntary market, there, to my knowledge, there really isn't a sound, I would say, institutional underpinning when it comes to trading in derivatives. And this is what is needed from what I'm hearing to make this market liquid and robust. And we can move to the next slide just to share a few experiences when it comes to the presence of financial institutions in the EU ETS, European Union Emissions Trading Scheme, which is a pretty robust system, has been in place since 2005. So we have a lot of experiences. But there is an interesting discussion right now going on in the EU around the role of financial institutions. So in 2018, carbon credits or carbon allowances, they have been designated as financial instruments, and that let financial institutions play a more active role in this market. So since then, since 2018, the participation of financial institutions grew by 143%. And right now, financial institutions, including investment funds, they they are the majority of the market participants who are holding so-called long positions. So this really shows us that they entered this market with an intention to really invest in carbon credits. So not trade them flexibly, but really almost use them as investment tools. And this has spurred a discussion in the EU, and something very, I think, interesting to be followed or paid attention to by the new jurisdictions that are considering carbon markets, because there is this conviction that the unobstructed, unregulated participation of financial institutions has led to this dramatic spike in the cost of the allowances that you can see on this graph here, going from something like 20 euros to 80 euros in just over a few years. So to avoid those mistakes, because I think all of this discussion is to the I'll say disadvantage of financial institutions, because I think they can play a very important role in ensuring liquidity of the market, but perhaps it should be designed with some more forethought. So, for instance, in California, financial institutions can participate in California's cap and trade, but there are some limitations as to their involvement. And in the EU, all of that led to the backlash pretty much, and so the legislation has been proposed earlier this year that aims to completely disqualify, so to speak, financial institutions from participating in this market, which is kind of going to the other extreme. So just those few thoughts for consideration for our subsequent discussion, and thank you very much, and I look forward to our panel discussion.
Thanks, Kasia. Maybe I'll take this opportunity now to invite Andrew from Verra to actually share on understanding the carbon verification standard, if that's okay, Andrew.
Indeed, yes, it is. So thank you very much, first of all, for the invitation to join you. What I wanted to do today, at your request, of course, is to talk through a bit more detail than we've covered so far on how verification works under a program like Verra's Verified Carbon Standard. So what I'll do is I'll talk through that, how it works, a bit of background on how the market is progressing, and then towards the end I'll come to some particular issues which are quite topical at the moment within the voluntary market space. But there is very much of a spillover between the compliance and voluntary spaces, as I think we've just been hearing about as well. So first of all, if you don't know Verra, we are an organization which runs a number of standards in the environmental and social space. The flagship program that we have is the Verified Carbon Standard, the VCS. This is a standard which has currently around 80% of the certification of credits which are used within the voluntary market. So it is quite significant. Obviously, there's over 1,800 projects which are all over the world, and on a cumulative basis, we're approaching now 1 billion credits which have been issued under the VCS. There's a variant to that, the Jurisdictional and Nested RED program, JNR. So this is looking at reducing emissions from deforestation, and but that program is operating at a jurisdictional level, so that's at a national level or a sub-national level, very much run through governments at those levels. In addition, we have a couple of sustainable development standards. One is CCB. If we can just go back to the previous slide for a moment. Yeah, so one is CCB, that's the one that's been around for the longest, the Climate, Community and Biodiversity Standard, and also a newer one, Sustainable Development Verified Impact Standard, or SDVISTA as it's called. So these sustainable development standards can also be layered across carbon standards in order to extend the criteria which are used within the standard setting process, and also, of course, add the value to the actual resulting credit. So yes, next slide, please. So first of all, I wanted to just give you a picture of how the voluntary market and also to some extent the compliance market has been developing in the last decade and a half or so. Within this, you can see the blue spike there. That's the clean development mechanism under the Kyoto Protocol. This was providing really the bulk of credits in earlier times. And that was, of course, with the use of the CDM credits within the emissions trading system, which was run under the EU. So that's where that real bulk of crediting has come from. Since then, however, you've seen quite a decline within the crediting which happens under the CDM, and it has been taken over, particularly in the last few years, very much by independent standards. VCS is one of them, I think the most prominent, but there's also Gold Standard and the American Carbon Registry and Climate Action Reserve. And these four programs make up the purple part of the chart here. So you can see that the very, very strong growth in the crediting has occurred via these independent standards. And that reflects the growth that we've seen in net zero targets and carbon neutrality targets, which have come into play. So we do have very much a situation at the moment where the voluntary carbon market is dominating the crediting scene. How long that will last, we don't know. Of course, there are movements under Article 6 of the Paris Agreement, whereby countries will be putting in place more compliance-style programs. And we can expect that that will be also taking up quite a big portion in the future. So next slide, please. So first of all, a little bit on why companies are moving into the crediting space. I think we've just been hearing some of this, particularly from Arena, so that I won't say too much here. But what we do see here is corporations are taking action which are very much complementing and supplementing their own work to reduce their climate footprint. So one of the catchphrases in the voluntary market space at the moment is the mitigation hierarchy, and this does put a lot of emphasis on companies taking action first within their own emissions in order to get these under control and to get them onto a pathway which is consistent with hitting that net zero position. And that's where the bulk of the activity around reductions should be taking place, but there is the ability to then use credits for the different purposes that we've just been hearing about in order to supplement that. And it has a number of other benefits. Particularly from a developing country side, it has the benefit of actually driving finance into mitigation opportunities. It helps them to meet their NDCs, the nationally determined commitments under the Paris Agreement. And what we can also see is that there's a lot of benefits from a sustainable development perspective as well, in driving technology change. And next slide. I think we've covered this already. I mean, there's really the different types of projects which are either focused on reducing emissions or removing emissions. And I think some of the key takeaways here is really that unit of the emission reduction or removal is always 1 metric ton of carbon dioxide equivalent gases. Next slide. So I'll say a little bit more here about how we actually go through the process of doing the certification of the reductions or the removals. There's a number of criteria which need to be met. We have quite an extensive standard which represents the core of the VCS program, but there's also a lot of additional pieces of guidance which make up the fuller program. The reductions need to be real. They need to have really genuinely occurred. That may sound rather obvious, but a lot of the other characteristics that you see on this slide are really ensuring that the real reductions and real removals to take place. So one is that it has to be measurable. We have an extensive set of methodologies which are approved under our program. We also make use of methodologies which are available under other programs, in particular the CDM under the Kyoto Protocol, in order to be able to measure the actual impact on emissions. So that those methodologies are very key, and they, in essence, define the scope of the certification program that we offer. Permanence is particularly an issue for land or based projects in the agricultural space, and in particular in the forestry space. The way that we do this, for example, is where a removal has occurred but is later reversed, could be through a forest fire or something like this, then we set up a buffer so that we actually channel a portion of the credits into the buffer, and those credits are then available to compensate for any later reversals which happen through land projects such as these. Additionality is a very key criteria. This specifies that the project should not have happened under normal circumstances. So it's really through the incentive that you have through being able to sell the credits, which is giving the impetus to the project. If the project would have gone through under normal circumstances, then doing the project and crediting under the BCS adds no environmental benefit. So additionality is very difficult to work out, but is very crucial, has been very crucial up till now under all crediting programs, and it continues to be an issue as we move forward. Independent verification is very key as well. We operate a system of third-party validation and verification bodies. So these are auditors who come in from the outside, outside ourselves and outside projects, of course. So in order to do the independent verification of projects and to vet those numbers for the levels of emission reductions or removals which occur. And transparency is very key. We list all the projects with all information. Also, what's very important is each credit which is issued has a unique serial number. So it's possible to trace how that credit is used for whatever purposes. Next slide. So this just gives a bit of scope for what our methodologies cover. You can see that it really covers many, many sectors. I think Irina has already talked about the kinds of projects which are available on those. Next slide. So this is the project cycle, a fairly simplified version of the project cycle that each project runs through. And although it can be quite lengthy and very detailed, it essentially is broken into two parts. One is the registration process in order to actually get the project registered. And once it's registered, then it goes through a cycle of issuing new credits. So for the registration, first of all, the methodology needs to be selected. There's a lot of documentation which needs to be written up. This needs to meet the requirements set out in our BCS standard. And once the documentation is together, it gets listed, and that allows then the first stage of the third-party verification to occur. So this is through the third-party auditors. If that is demonstrated that the project is in keeping with all of the criteria, then the project moves on to being registered. And from that point, the implementation of the project goes through the cycle of issuance that I talked about. It's made up primarily of the monitoring of the actual emission reductions or removals which are occurring. That goes through a third-party verification again, and then it leads to the actual issuance of the credits. And you can see at a number of points throughout this process, there are also stages where we at Verra have our teams doing checks and reviews to make sure that the rules are all being adhered to. Next slide. The broader sustainable development objectives. This has been something which has been very prominent in the voluntary market, where projects have really emphasized the need to build up other sustainable development priorities and actions within the projects. It's been less of an issue in the past on the compliance markets, but it will be interesting to see if more of the sustainable development emphasis moves into the compliance space. So this is where, again, we have within BCS, there's a core set of requirements which need to be met, which pertain to broader sustainable development issues. we require that at least 3 sustainable development goals need to be demonstrated within the project. But if projects wish to go further than that, then it's possible to layer in the other programs that I mentioned, the CCB and the SD Vista programs. Next slide. So what we've seen, and this is not only Verra, this is across the full market, what we've seen is very much an explosion of project action in many sectors and many project types. They do tend to focus around the big ones that I've mentioned here: renewable energy, which is still almost 40% of the market, forestry and land use also around 40%. The agriculture is currently quite small in terms of the overall voluntary market, but is expanding quite significantly, and it is, as we've just been hearing, one of the areas which is very much focused on removals as well as to some extent reductions, and this is something which will be very key as we move on towards the net zero position. Next slide. Another development which I think we're going to be seeing much more of is that host countries will be taking a much more prominent role within the project setups. So what has been the case in the past under the voluntary market is that governments were really not in the picture, and in many cases governments were not really even aware that projects under the voluntary market were happening in their countries. This does contrast with what was happening under the CDM for the Kyoto Protocol, where there was a specific approval process where the host countries actually needed to give their approval before the project could be registered and could move ahead. It is something which we expect to be taking place much more in the voluntary market space as well as we go forward. This is largely because of the Paris Agreement coming into being. As you know, the Paris Agreement covers contributions by all countries and not just developed countries, as was the case under Kyoto, which means that the countries in which these projects are occurring, the countries themselves, the governments, need to take responsibility for the emissions across their economies. So in that context, countries are going to be much more aware of the need to manage their own emission levels, and I think we increasingly see countries seeing the carbon market as a particular tool in where they can manage the inflow of finance. They can give guidance around what projects should be occurring. That might even go to the point of giving approval processes within the voluntary market space as well. So you'll see much more engagement from countries in order to manage the way carbon market activities happen on their territories. That largely gets broken, sorry, just on the previous slide for a moment, that largely gets broken into 3 areas as we see it. Around strategy, this is where host countries are beginning to think much more clearly about how their nationally determined contributions under Paris are going to be met, and therefore where they're able to make emission reductions themselves and where they really need the international support through things like the carbon markets. Project guidance, here we do see that a lot of countries will be selecting specific sectors or specific project activities where they wish to promote these as the prominent area for market projects to work. It's also very likely that countries will begin to layer over the kind of sustainable development priorities that they wish to see within these projects, and that will no doubt be then summarized into approval processes that they'll be establishing. And then project oversight, this is where a lot of countries will be tracking the activities. They'll and also having a stake sometimes in the actual credits which get generated from them in order to be able to have that control of their emissions and their ability to meet their NDCs. So the next slide. So I think we've covered this already, the distinction between compliance and and voluntary markets. I think the one thing that I'd like to say on this is that the distinction for us between compliance and voluntary markets is very much about what actually drives the demand. So under compliance markets, you've got government regulation, which is driving entities into demanding credits, whereas under the voluntary market, you've got the net zero targets, you've got carbon neutrality claims. So this is what drives companies to go out and to purchase carbon credits. In earlier times, what we saw is the voluntary market was distinguished by the use of specific independent standards, and the VCS is a prominent one in that case. I think that is breaking down in the sense that the programs like the VCS, what they do is they generate credits, and those credits can then be used on either the compliance markets or the voluntary markets. And I think what we're seeing is very much the movement towards accepting independent standards like the VCS in both compliance and voluntary markets, and the distinction is really on the demand side as to whether we consider something to be voluntary or compliance. Next slide. I think on this, on this last slide here, I just wanted to mention two initiatives which have been moving quite rapidly forward over the last year or so. These are both initiatives which impact on the integrity of the way the crediting is done and the way the credits are used. And we have Mark Kemba on the panel shortly, so he's very much involved in both of these initiatives, so I'm sure he'll be saying a bit more about it. But generally speaking, we have the Integrity Council for the Voluntary Carbon Market, which is an initiative which is very active on the supply side in the voluntary carbon market. It's very much geared towards ensuring that there's a minimum level of environmental integrity within the credits which are generated across the voluntary carbon market. Their motto is build integrity and scale will follow. So it is very much driving towards the idea of being able to use carbon markets at a much greater level that we've seen so far in order to drive mitigation. But in order to get there, you need to build up the assurance of integrity and environmental quality. So it addresses the kind of key attributes which I was talking about before in the context of the VCS. There are the core carbon principles which are being developed, and this essentially programs like our VCS will be assessed against the core carbon principles in order to work out whether we conform to that new integrity standard which is coming into being. On the demand side, what we're seeing there is the VCMI, the Voluntary Carbon Market Integrity Initiative. So this is not focusing on the quality of the credits, it's focusing on what companies are able to do with those credits once they have them. And it is very much based around the mitigation hierarchy, where it is seen to, the main focus should be on companies reducing their carbon footprints, and the use of carbon credits can be used as well, but it is more limited than being able to apply them directly against the accounting of a company's carbon target. What we see with the VCMI as being very key is that it offers us an opportunity to stake out an area where there is a legitimate use of carbon credits, because there has been a lot of discussion and a lot of criticism against the idea of offsetting. And the world, the voluntary market is very much moving on from the way that credits have been used in the past. And what is very important through the VCMI is to be able to stake out a legitimate way of being able to use these credits as we go forward. So I think that's all I had to say. So thank you for the opportunity again, and I look forward to the discussion.
Thank you, Andrew. So please stay on, and we already have quite a number of Q&As in the chat, but happy to just, before we get into the panel discussion, it's good that we talk about gender. And this is where, if I can invite Sue Phillips to just share a bit on how gender would typically be come into play and critical for this. Over to you.
Yeah, thanks, Lena. And thanks, Andrew, because I think Andrew sort of led into this whole question of high integrity and how that is becoming increasingly important to both the demand and supply sides of the voluntary carbon market. I'm just very briefly going to talk to some 5 key messages that I guess came out of some recent piece of research funded by the UK government on looking at gender and voluntary carbon markets. And, you know, why does it matter? What's gender got to do with it? So just that 5 key things to be thinking about as around the sort of question of integrity. And the first thing is that women make a difference to climate results. And to really stay very focused on the fact that women are at the front line of climate action. They play a major role in agriculture, in forest management, in management of nature-based solutions, and we've seen that how important and growing those areas are from previous presentations. And linked to that, there's growing evidence that actually that women management nature-based solutions actually have performance advantages too. I won't say they always perform better than those managed by men, but there's growing evidence that where women are leading those initiatives or playing a major role in those initiatives, that there is evidence of better results. And obviously there's some asset types that are particularly key, where women are particularly visible, as I've just outlined. So secondly, not just that they make a difference, but we need to be really focused on the design of adaptation and mitigation activities, as they can worsen both gender and wider social inequality and equity. And to keep in mind here, the gender gap, I mean, World Economic Forum estimates sort of saying that it's going to take 136 years to reach parity between men and women globally. That was made worse by COVID, where disproportionately women were affected, and similarly with climate change is worsening gender and social inequities. So impacts are felt experienced disproportionately by women. So it's essential when we're thinking about the voluntary carbon markets that the role and impact of those mitigation activities on women are considered, fully considered, and not just in terms of protections to make sure that that activities, projects unwittingly make things worse for women, but also that there are opportunities that are inbuilt within those activities, co-benefits, so opportunities to deliver on sustainable development goals also offer great opportunities to reduce that gender gap. If there is one thing that would lead to a step change in the voluntary carbon market from where it is right now, is seeing equal participation and representation of women throughout the market. There's no better way really to make sure that women are visible than having them at the table. And we're increasingly seeing perhaps 1 or 2 women included in decision-making, but really that can often be tokenism, not make a difference. Where we're seeing the real impacts is where there's a significant participation of women at the table. And if there's one stat that I was thinking that would really sort of demonstrate this and the lack of visibility and the lack of flow of benefits to women, that's a standout, is that in a 2016 UNDP report, calculated that only 0.01% of all worldwide climate funding goes to climate change and women's rights and climate change. Sorry, I got that a bit tongue-tied, didn't I? But I think you get the point. Such a tiny percentage of climate funding is going to women. So that's something in the context that we've just been talking about, hearing about this massive scale up of finance, to really focus on how much of that is actually reaching women on the ground, women-led businesses, women-led organizations, and those that are actively involved in climate action. Moving on, what we're seeing, two key things came out of the research, that we're seeing corporate buyer interest and demand is growing in carbon credits that actually are delivering benefits for women, particularly those that are consumer facing, particularly those who have a long track record in corporate social responsibility and gender equality concerns. And we can expect growing demand as the buyers increasingly link their climate and their ESG portfolios. And they're looking for evidence. Then another key message from the research is that they don't necessarily trust the labeling of some of the carbon crediting programs. They want to see real evidence that that those programs are delivering real benefits for women. And then finally, not all crediting programs, the standards are equal. We've heard from Andrew at Verra, and the standards, the VCS, the CCB and the SD Vista in particular, focus on, bring a focus in on women, ask questions, include indicators. And Verra also has the add-on of a W+ standard, which actually is a way of measuring impacts on women. Gold standard makes it mandatory for gender sensitivity to be built into their crediting program. But others, it's either totally absent or very high level principles, statements that with very little guidance on, well, what should project developers do in order to achieve those ends. So that's a very quick introduction, and very happy to take have more discussion as part of the panel discussion. Thank you.
Thank you, Sue. Definitely we see a need to have a very just transition when you talk about the solutioning and the carbon credit market as well. So I'm actually very privileged to now have the panel come back into the panel discussion. And this is where we also have Mark Kember, Executive Director of Voluntary Carbon Market Integrity Initiative, who has joined this panel as well, alongside Kasia, Andrew, and Sue, for us to take on some of the Q&As that have come through the chat. Maybe I'll kickstart with the first key questions, and this is something that can be answered by Mark, yourself, or Andrew. So who will be the authorized entity or in Malaysia to be the verification body on the carbon credit or offset project? So I think, Andrew, I think you're more aware as well when it comes to the work that Bursa is also developing. So happy to have Andrew and Mark to share as well.
Sure, and I mean, I'm not aware of the specific individual entities which are on the ground in Malaysia itself, but generally speaking, we have access to a network of VVBs which are either accredited through the International Accreditation System, which is set up. So this is all developed under ISO, and there's a network of bodies which are designated through them. There's also access to the designated operational entities which exist under the Kyoto Protocol's CDM mechanism. So that's actually a larger set. I think that's around 200 entities. The last I heard of, it might be a bit lower now, but that's available globally. It's not necessary to use a VBB which is resident in Malaysia. You can have one from anywhere. Typically, of course, costs are going to be lower if you can find one. Something which we could share after this meeting, in fact, I could even put it into the chat, is we have on our website a list of entities. So that would help with more specific information.
Just to add to that, I mean, I think what Andrew's been referring to are the organizations which tend to be from the private sector, though they may be NGOs who do validation and verification, and those tend to be accredited by the standards such as VERA, as it was under the CDM, and others. When you talk about authorization, that's a kind of a new issue where governments decide whether or not to authorize projects so that the credits that are generated can be used towards their NDCs or not. And the infrastructure for that is slowly being developed. I mean, I think Andrew knows more about the kind of on the ground details of that than I do. And that's may not be important for the next year or two around voluntary carbon markets, but as voluntary carbon markets and compliance markets, particularly the markets developed under the Paris Agreement, become the borders between them become more fuzzy, where companies want to use credits potentially for compliance purposes or certain claims about them, then the role of governments in authorizing projects, both so that they, as other speakers have said, target investments where they're most needed, but also because it has implications for how they count emissions and emissions reduced and removed towards meeting their NDCs, will become extremely important. And that's looks to be quite contested over the next few years.
Thanks, Mark and Andrew. I think follow up on that, there has been also concerns when it comes to how does one ensure that the same carbon credit is not double counted, which is a very common questions that we hear. So I know, Andrew, you've covered it slightly, but maybe Mark, let's have the opportunity for you to take on this, given the experience that you've had at BCMI.
Thank you. I mean, the issue of double counting and double claiming, and I'll explain the difference in a moment, are absolutely crucial. I think double counting, when it comes in the voluntary carbon market, what that refers to is more than one company using a given credit to meet their own voluntary targets, or whether they're allowed to use credits for compliance purposes for that purpose. So that is relatively straightforward. All the registries, such as the one that VERA has, but all the other standards as well, make it very clear that once a credit has been moved from sort of an active account to a retirement account, i.e. it's been retired to make a claim, then it cannot be used again. Now, there is a risk that companies have, that projects have credits issued under different standards, but and Andrew can confirm this, the major standards are pretty clear that they cross-check against each other to make sure that projects and credits are not registered in more than one registry. The perhaps trickier question is about claims. So a lot of the work that the Voluntary Carbon Market Integrity Initiative does is set rules or guidance for when companies can credibly use voluntary carbon credits, but also what they can say about it, things like carbon neutral, net zero aligned, and so on and so forth. And this goes back to the point I made about authorization and the links to the Paris Agreement. There, it's not so much double counting, but for example, if a voluntary carbon project took place in Malaysia and reduced emissions, and Malaysia took those emission reductions into account in its national accounting, but a private buyer, for example, in my country, the UK, used that credit to substantiate a claim of carbon neutrality, although they're accounted for in different systems, so there's not double counting, there are some suggestion that would be double claiming, because Malaysia would be saying we've reduced our emissions, and this company would also say we've bought credits which count towards reducing our emissions. And there is a lot of debate about whether that's important, how important it is, and how it should be dealt with.
Thanks, Mark. That is definitely under the purview of Bursa, and definitely they are looking at how to ensure that there is that clarification, especially when Malaysia as a country also have the commitment to reduce emissions. Maybe I will take that into a unique turn when it comes to implementation. Any of the panel can share an example of a project journey that participates in the voluntary carbon market. For example, if it's a very typical renewable power project, what are the typical hurdles if they have not gotten the carbon credit certified? maybe Andrew, this is up your alley, so happy to have you to share.
Sorry, can you repeat the question again? Sorry.
Yeah. So if we talk about the renewable power energy project that hasn't gone on certification, what are the common hurdles that you've seen?
The common hurdles to renewable energy projects.
Yeah.
A lot of the experience that we've had within Verra has on renewable energy, and I think Mark has also been part of the discussion because he's been part of the or he is part of the board for Verra as well, under his other titles. So Verra has had a lot of experience, obviously, with renewable energy projects in the past. There has been a lot of criticism around whether they really constitute an additional project and whether they should be considered under Verra. So Verra has actually taken the step of going forwards, no longer allowing renewable projects within our BCS program, unless they are in least developed countries. So that's been one of the steps that we've taken. I think this is back in 2019. Mark might need to confirm that, in order to ensure that there are no non-additional renewable energy projects coming into the BCS. Now, that was at the time quite a controversial decision, because there may well be some projects which may have very good case that they might make for the fact that they should be considered additional, but it was becoming so difficult to make the distinction as a regulator and of the standard, that Verra took that decision back in 2019.
Thanks, Andrew. Maybe before we go on, I think the key question is, I think Mark, you've partially answered some of the costs but there is another question that came in. Now, what's the estimated cost of verification and validation during design stage, construction and implementation stage? This company has to pay for this cost. So I know, maybe I'll point to Mark if you can give that overview.
I'm afraid that's not really, I don't get, well, for 15 years I haven't been involved in projects on the ground. I suspect Andrew knows this, but I can imagine Cassia might. I mean, I don't know how much work you do with specific project developers and project, but I imagine you've got a much better sense of that than I have. So I'm going to pass the buck on this one, I'm afraid.
No worries, Cassia. Happy to have your views as well on this, given that you've also been in discussions with some of the policymakers in the region. Cassia, I think you're on mute.
Yeah, has to happen every time. Yeah, so end-to-end costs, very roughly speaking, and that also includes, on top of project certification, etc., the overall assistance, also helping to connect with local communities, NGOs. So everything that has to go into full-fledged support with the project is around $200,000 per investment. So if the investor is thinking about 3 projects that are of completely different nature, like one is around let's say reforestation, one is around cook stove, these will be completely separate projects. And obviously the price also depends on the standard that is ultimately selected for a given project, but that's roughly the estimate, the ballpark for the entire end-to-end support with a project that has a lot of components, right? Also analysis of co-benefits, etc. So that's more or less the number we're talking about. And that obviously is notwithstanding the actual cost of, let's say, assets that have to be developed or acquired for the development of a project.
Thanks. Andrew, do you have, would you like to chip in on this? Because there's a few questions that came up. Otherwise, I'll get to the next question, Andrew.
Yeah, and we also don't actually see the costs which the project developers are facing for the third-party auditing that they go through. So it's very difficult for us to say as well. I mean, generally speaking, projects are looking for local entities, local auditors who are able to do this. It cuts down costs quite considerably. but we also don't have access to the actual costs themselves.
No worries. So I think the question, Andrew, is in your VCS program, what percentage of offsets can be attributed to tropical countries? To trying to understand where tropical countries stands globally when it comes to carbon trade. Are they collectively minor players?
In certain project types, they're major players. So particularly around the forestry projects and of course the REDD projects, so it's reducing deforestation. This is amongst these project types, tropical countries are very much the main countries. So the forestry projects across the voluntary market is around 40%. So that's obviously quite a significant player. I don't have at hand the specific breakdown for tropical countries across other project types, but the majority of that 40% is tropical countries, tropical forest countries.
Sure. And this ties in nicely with one question as well that connects. What happens if there's a change of risk at the end of the project completion, such as climate change impact, typically like flood or high sea level rise? Does investor need to invest for rectification and additional insurance costs, if any?
Is this around the possible reversal of removals?
Yes.
Yeah. So this is quite a difficult area for crediting projects, and different standards have slightly different ways of dealing with it. The one that I mentioned for the VCS is the buffer approach, and it was actually the VCS which pioneered this approach quite some years ago, and has been picked up by other programs as well. So it's the buffer pool acts almost like a collective insurance program. So what happens with each project in the forestry or agricultural space, there's an assessment done on the project to determine what the risk of a possible future reversal in the carbon removals is. So what's the risk of a forest fire perhaps, or what's the risk of harvesting? And that assessment of the risk determines how many or what proportion of the project credits would be channeled into the buffer pool. And where a reversal is identified at a later point, then that is compensated from credits which are sitting within the buffer pool. So it works as a kind of insurance scheme for the voluntary carbon market projects which are active in the land sector. So that's the approach that we've used so far. There's a lot of discussion around it currently around, are there additional measures which should be put in place? Generally speaking, what we think is that there's a need for a number of measures in order to ensure the right level of assurance of permanence in such projects. The buffer is the key part of it. Another part is that there needs to be a requirement for the projects to continue monitoring projects. We specify currently a period of 30 years for that monitoring. There is discussion about whether that should be extended further into the future, but that does become very difficult because it's very difficult for any company to commit even 30 years out. And there is discussion about committing to 100 years out. And I think our view at Verra is that it's very difficult to get such commitments, and even if you get them, you may not be able to believe them. So another avenue which has been tested out is to try and develop insurance products. So there has been some progress in this area, but generally speaking, I think a lot of insurance providers have found it quite difficult to specify the level of risk that they face, and therefore, we haven't seen a proliferation of insurance products coming into the market for this. What we're doing within Verra is to develop a long-term monitoring system which in many cases will be based around satellite remote sensing, in order to try and extend out the period of time even beyond the 30 years in which monitoring occurs, and we would use the buffer in order to manage that going forward. So there's, generally speaking, permanence is a difficult issue that we need to grapple with, but there are a number of tools for dealing with it, and our sense is that we actually need a combination of these buffer, insurance, and contractual periods in order to be able to get the right kind of assurance.
Thank you. Because there is a follow.
Arina, just to add to that, I mean, I agree with everything that Andrew said. I think the obviously permanence is a key issue, and we have to sort of bear in mind that there is the difference in time frame or time horizon between insurers and project developers on the one hand, 20, maybe 30, but 100 years is a stretch, and the half-life of carbon dioxide in the atmosphere, which is about 6,000 years. And obviously we want permanence must mean on one level forever and ever, because otherwise it causes climate change. But on the other hand, we need to be practical about it. And this is what a lot of these tools are trying to do. But I think there's a more general question, general answer to the question that was raised about sort of who bears the risk, not only for impermanence of forest projects, but if a project goes wrong, well, that's no different from any other contract in any other market. The buyers and sellers will have an agreement on liability, who bears the risk if a project underdelivers, doesn't deliver, and that's no different from delivering carbon credits than it is electricity or meat or any other product or commodity in the market. And that's something that the project developer, the intermediaries and the buyers will have to agree between them, and there's likely to be some insurance or risk sharing mechanism built into that as well.
All right. It sounds as the question has asked, if the damage is permanent, i.e. to a point of like force majeure, there needs to be a consideration of such risks as Mark you've mentioned in that respect. No different from any business risk or the way this has been crafted. I guess the key thing is also, I'm not sure, Andrew, you mentioned about the timing factor, but I think the question is also for the buffer pool that compensates, is it per annum basis?
An annual basis?
Is it for a per annum basis, or it's over a period of time?
It's in order to trigger a compensation from the buffer pool, there needs to be a specific loss event identified, and then the compensation is for that loss, which depending on the circumstances of the loss, may be a one-off event, or it could occur over a period of time. But it's specific to the loss event.
Sure, thanks. I think we've gone into a very technical question, but let me go towards Kasia, if I may. So for Kasia, I think what we've seen is for financial institutions, there are roles definitely in terms of how financial institutions are going to navigate. Do you see, based on the experiences, the interaction or the role that financial institutions can play would really depend on how mature the willingness and the readiness for the financial institutions to be part of the carbon market? Now, what have you seen in the region?
Yeah, so obviously the role that financial institutions can play depends on the maturity of the underlying system itself, right? And obviously compliance markets have way more, I would say, assurance when it comes to the legal ramifications that financial institutions will be operating in. But also there are other considerations as well that might determine the willingness or not of financial institutions to enter this space. So for instance, the question around how carbon credits of various sorts are treated by regulators when it comes to how much capital has to be held against or sort of assured or provided by the financial institution to mitigate any perceived risk that those instruments might be having. So for instance, in the EU ETS, as far as I remember, carbon credits are considered to have one of the most significant risk, and they are being placed in the bucket that is that carries the most weight when it comes to additional capital requirements. So I think the risk attributed to those instruments is around 60%. So that's how much how much more money effectively the bank has to be holding against those instruments. So obviously that is a strong deterrent from being more active in this space. So but this will be defined and imposed by every jurisdiction that is setting up ramifications for trading in those credits, whether it is for voluntary purposes or compliance.
Thanks, Cassia. One question came up when it comes to promoting gender, Sue. So maybe if I can turn to you is, how should buyers go about seeking credits that promote gender and sustainable development? What have you seen is a success factor? So it helps the issuer to also, come forward with some of these when they are issuing as well.
Oh, good question. I think I would definitely say, start with the registries and the standards, because there's some like Vera, like Gold Standard, like Plan Vivo, others that are very much more focused on those sorts of initiatives that are community-based. Communities are strongly involved. They're the sorts of initiatives where you're more likely to see benefits for women. The labeling, start with the labeling. Anything labeled SDG 5 is something that's intended to, or shown that it's benefiting women. That's the SDG 5 is the gender equality sustainable development goal. But I would also say, and this is come from reviewing some programs and feedback from our research, is go deeper. Ask the questions, and some of the key questions are around, are projects, project developers, project owners, are they women owned? What percentage of women are participating in the management of those projects on the ground? What percentage are including of women are employed? These sorts of indicators give some indication of the seriousness with which a project has really meaningfully addressed women's needs. And then I guess the final thing I would say is there are some measures out there where they really go deeply on looking at gender impacts, and Vera has the W+ standard as one of its accredited methodologies, which looks at impacts.
Thanks, Sue. Going back to Cassia, I think one key thing is, what would be a push factor in the region, or at least, in your conversations with some of the countries in the region that's looking at taxonomy, whether it's ETS or carbon tax, what would be a push factor to increase the participation in the market? I know the EU CBAM is also going to be a pressure factor, but happy to get your thoughts as well.
Yeah, there are several push factors, I would say. So right now, having domestic climate policies, it's almost like getting a competitive advantage, so to speak, because, and that comes from many different angles. So for instance, when investors are looking into locating their, or maybe enhancing their operations in various countries around the world, this increasingly is becoming a factor. Then also countries will want to monetize on the Paris Agreement and Article 6, especially countries, a lot of countries from Asian region, they are, I think, starting to look at climate policies as something that can bring about significant financial advantages, as countries from for instance, Europe will start looking into sourcing ITMOs, so international transfer mitigation outcomes, from countries, for instance, like Malaysia. So really having the proper guardrails and legal ramifications will help those countries to actively participate in Article 6 and market-based mechanisms. So this is, I think, this is really a game changer when we look at climate policies, less from kind of liability or imposing a new liability on the businesses, and more like this is a new marketplace, like I was explaining before. Let's make sure we take part in it, and this cannot be possible without setting up legal regimes to govern this domestically.
So I guess the question open to panel is, given the way forward and what we're seeing in globally, if the for Malaysia, whereby if the tax is being implemented, whether it's ETS or carbon tax, will this change the carbon market mechanism?
Well, I'll jump in. I think it depends a lot on the design of the system that Malaysia puts in place. So two key elements would be to the extent to which Malaysian companies are required to meet emissions targets, and to the extent to which they can invest in domestic projects, for example, forest protection or restoration or in any of the other sectors to meet those targets. That's similar to the approach that Colombia has in place that Andrew can talk to, because Vera has been very closely engaged in designing and managing that. It will also depend to the extent to which the Malaysian government allows credits to be exported. So we've heard of several countries that have either threatened or legislated that carbon credits either indefinitely or temporarily cannot be exported until they have a better sense of what they need to meet their NDCs. Then if export of credits is allowed, whether those have to be authorized under Article 6 of the Paris Agreement or not, i.e. that accounting adjustment, which will, although no one quite knows how, it will affect prices, it will affect demand, and it will affect supply. And those are all unknown at the moment. So the answer to your question is it's very difficult to tell. It depends both on domestic design and how international rules are applied. But I think what we've seen from Andrew's slides and others speaking earlier, there is likely to be more demand for this. Part of the demand, how much the demand will depend on organisations like mine, and to the extent to which our guidance is accepted or not as to when companies can use credits. But there'll be a lot of factors. But I expect demand continue to grow. The urgency of the issue that we're facing suggests that we need all the investment we can get. What it actually looks like remains to be seen. But I would just kind of finalise by saying I think, given that there is likely to demand, that projects that are voluntary carbon market projects often use the same methodologies and the same approaches as those that may be allowed under Article 6.4 or for transfers under Article 6.2 of the Paris Agreement. There's no need to wait. And so I don't think the carbon market has been plagued by uncertainty for 20 years, and they've managed to go up and down and generally grow over the last 20 years. So I don't think the uncertainty should be a reason not to look into doing projects or other activities now.
Thanks, Mark. I think some of the questions have also been answered as you've gone through that explanation. We've come to the hour, but I see quite a number of questions. So I think what we'll do is, if there are any answers, I think feel free to put into the response here. Very quickly, if I can get the panelists to have a look at the question, and you can type your answers in there while we actually put up the poll. What's important is the purpose of this forum is really to advance the conversations and allow the market participants, financial institutions, players, issuers, all to come together to actually facilitate the advancement in this area. So we appreciate the workshop feedback. There are 3 questions that we have here. If we can actually get the participants to at least just quickly feedback, do you find the workshop useful? While the panelists helps to answer some of the questions in the chat. Second is, do you find the workshop effective in creating your understanding on the carbon market and carbon pricing instruments, and as well as integration of GNI in the voluntary carbon market? So feel free to put in while we have some of the other questions being. So a quick one, Andrew, while everyone's responding, some of the fast ones. Will degraded forests that have been converted to forest plantations be considered?
I'm not sure. I don't know the answer to that one. Yeah, I'm sorry. I cannot. I would need to consult with my specialist colleagues in that area.
Sure. So maybe if we have the polling done, we want to thank everyone for the opportunity to join the session and forum. It is quite a number of areas. While there has been advancement on the voluntary carbon market as well as carbon credit, there are still a lot of areas that are being developed, as we know. So it is very good that we continue the forum and conversations, but we would like to give a very big thank you to Andrew, Mark, Sue, Kasia for joining this very important panel with the Capital Markets Malaysia. And with that, we wish everyone a good day ahead, and thank you.
Thank you very much. Bye-bye.
Thank you very much.
Thank
Bye-bye.
you.